Hey, Steve Saretsky here. As always, a Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask you hit thumbs up and subscribe. Questions, comments, put those below. I wanted to touch this week on, first and foremost, I'm writing my monthly Saretsky report. It's kind of like a 20-page deep dive on the Vancouver housing market, my thoughts on Canadian policies that might impact real estate in general. It's not going to be released yet as of this recording here, but if you do want to be one of the first on that to get that monthly report to your email, there's going to be a link in the description below where you can go and sign up. But the reason why I bring this up is because as I'm writing my 20-page report here, sitting down for 4 or 5 hours, writing it really kind of makes you think, and you're doing a lot of research, and one of the things I try to do in these reports is ultimately just trying to tell a story, because I think that people can understand the world a little bit better. They can start to rationalize things when they hear it from a story, as opposed to just hitting people with data points and 1,000 different numbers and charts, etc. But so I like to kind of help paint a picture and visualize it. And one of the things that I was trying to do in that report was I was trying to explain to people why house prices were going up. Trying to rationalize why they're going up, and trying to create a story and a thesis as to why I was becoming bullish on the real estate market here. As I've said in my past videos, I just posted my latest interview on Yahoo Finance, in front of a global audience across all of Canada. I got on there and made a call that maybe we're starting the beginnings of a bull market. So it certainly wasn't easy for someone like myself to swallow my pride and say something like that. Obviously, I'll be the first to admit I was pretty bearish back in March and April when it looked like the world was coming to an end. The natural inclination was that this would be a significant shock to the economy, and that should thus filter through into the housing market. And I think anyone could have agreed with that rationale at the time. But now we fast forward here, 8 months into this pandemic, and 8 months into this recession, and again, house prices. Not only are we seeing home sales at record highs, but prices at record highs in a lot of instances. And so, trying to explain this to people, it kind of, reminds me to go back and look at last week's video when I asked everybody, if you were to go up to your friends and family and ask them, if they understood what the central bank is, what it does, and how money is actually created. And it seems like a lot of you commented in the comments below that about 99% of people you figured didn't have an understanding of these systems, and that's kind of my view of it as well. And so when I look at it and try to frame it up, what I really like to focus on is I try to stay out of the politics of all of it. The politics of foreign buyers, the politics of not building enough housing supply, all the politics behind all these these real estate stories. And what I really try to do is focus on the financial markets, looking at what the banks are doing, because at the end of the day, Canada is controlled by 5 major banks. Okay, so it's basically this oligopoly system, and what you have to understand is when you start to figure out how money is actually created, it starts to help you create this framework, and so you can start to justify why valuations in Canada are so egregious, why the Canadian banks basically dominate our lifestyle. So what you have to know is that just over 95% of money, as people define it, over 95% of money is actually created via commercial banks. And that money is created when banks create new loans, i.e. majority of those loans being mortgage loans. So basically what happens is new money is created into the system when a commercial bank, such as RBC Bank, clicks a button on their keyboard and creates you a new loan. So the banks, despite mainstream economic thinking and what the textbooks told you, maybe back in the day what your teacher told you in high school or economics 101 and in post-secondary, is that banks don't just take your deposit. So if you go and deposit $100 at the bank, check for $100, they don't just take that and lend it out, of a multiple of 10. It's not really that simplistic. They don't actually really rely on deposit. Yes, they have capital requirements, but they don't necessarily depend on deposits. They're not. What they actually do is they actually create money out of thin air by by basically hitting keystrokes on a keyboard and creating new money into the system. And when you start to understand that those loans, that new money that is created, so debt is money, when you understand that those loans that the commercial banks create are ultimately backed against the collateral of those loans is housing. So take, just so we can slow it down here so you understand. Take the loan. So you go in, you want a mortgage. RBC gives you a mortgage. They are literally creating money now into the financial system. They've created that loan a little thinner by clicking a keyboard. So that new money is essentially, they've created new debt. So by doing that loan now that they've given you a mortgage, it's securitized against the asset, the value of your home. So you can imagine a scenario when you have 5 big banks working in unison, that they have a collective mutual benefit to support the underlying asset price, because that is the bank's collateral. The bank's collateral is your home. And so it's the same thing when we look and see what's happening in the property market. Why do governments continuously go to support the housing market? Because in order to drive GDP growth, you need to create credit. And how do you create credit? You create credit by issuing new loans via commercial banks such as RBC. And in reality, as a banker, the easiest way or the safest way to issue a loan, if you have 2 options. If you can issue a loan, create a business loan to some, mom and pa's pizza parlor down the road, or you can lend it against a single family house in East Vancouver, what would you do as the bank? So you can either lend against this house, an 80% loan to value, or you can, lend to mom and pop pizza parlor that could very well, go out of business in the next 12 months. So the choice is very obvious. Is the banks typically tend to funnel the money into mortgages, particularly residential mortgages, because they're safe, because they're implicitly supported basically by the government. It's kind of this almost like a handshake agreement that you have. And when you logistically think about it, is, particularly for, like, let's say an insured mortgage, a CMHC insured mortgage, where you're putting down less than 20%, that's federally guaranteed. That loan is federally guaranteed. So the risk to the banks to actually create that loan is very, very minuscule. And so so let's understand this whole picture. So remember, in April, the economy is tanking. Everybody's losing their job. People are panicking. And everybody was under the notion, myself included, that the banks would have to tighten credit, because how do you issue a loan to somebody that may or may not have a job in 2 or 3 weeks? Well, we fast forward 2 months and all these fiscal and monetary policies coming out to basically support the financial system. All of a sudden we start seeing multiple offers in the housing market. All of a sudden we start to see, right now particularly, is you're seeing all these single family houses going into multiple offers, selling above the asking price. So everybody's coming in, all cash offers. You go, in order to do that, you have to have the utmost confidence that your bank, your lender, is going to lend you money. So that basically tells me again that the banks are out there aggressively lending money. And this is not just like this me pontificating. Again, all you have to do is look at the data. So you look at it and say, okay, well, if we actually look at residential mortgage credit growth, why is it accelerating at 6% per year? So you have 6% annual growth, again, during this recession. It's growing at the same pace it did back in 2017 prior to the mortgage stress test. So it's growing at an enormous pace. And not only that, but now you can see again where this is going. So the banks are aggressively issuing credit, and you probably have mandates from OSFI and the federal government saying, hey, listen, we need to keep the credit spigots open. We will allow you to lend. We're going to help you with these capital buffers. We're going to help you through quantitative easing and all these policy measures, because we need you to get that credit out the door to keep the economy from falling flat on its face. And so that money, again, is being directed into the housing market, because in Canada, it's that one trade gravy train that never ends. And it is essentially federally backstopped. So again, don't come at me and shoot the messenger. This is me trying to explain the system to you. You can like it or disagree with it. I mean, certainly, I think having the power in the commercial banking hands is creating these opportunities. Obviously, we've now created, to call a spade, you've created an asset bubble. You've created enormous debt loads that, unless these debt loads continue to grow, the whole system topples over. So it must continue to grow, and eventually I'm sure it will pop. But again, is that in a year from now? Is that in 10 years from now? Eventually that will go. But again, people have been saying that, for example, since 2008. And so from 2008, you've seen more than a doubling in home prices. So it's like, even if it drops 50%, you still missed the trade. It's the exact same people that called Tesla a bubble at $100 a share, and the same people that started shorting it at $200 a share and $300 a share, and now it's $600 a share. It was probably a bubble back at 100, and it's probably a bubble today at 600, creating these massive PEs. But it doesn't matter, because you still miss the trade. So it's not necessarily about what you think should happen. It's necessarily what is happening in that trade. And I can tell you right now is that my bullish thesis is because I'm watching what the banks are doing. We just had so gather this. So I've just given you the whole explanation of how credit is created, that why the banks are essentially incentivized to keep lending into the residential housing market, because that is ultimately their collateral. If prices drop 40% tomorrow, that's the bank that's taking the loss. That's their collateral. So they're incentivized to maintain the value of their collateral. And at the same time, they know that they have the governments at their mercy, because this is the main mechanism of credit creation, is through creating new residential mortgage loans. So that's the system. Now, as I'm going to try to explain, so you have that backdrop, and now, so again, we're seeing, let's break this down. So you have residential mortgage credit growth accelerating. We have record home sales across Canada. We see double-digit price appreciation across the nation. And now we have the federal government, Trudeau came out this past week saying, well, we're actually going to increase the first-time home buyers incentive in Vancouver and Toronto and Victoria, now up to, I believe, $722,000. Now, I get it. I understand that the program it wasn't very well receptive. Didn't have much take-up. The interworkings of the program were kind of ridiculous to begin with. It's basically this shared equity program that really didn't make a whole lot of sense under the old guidelines. But now that you start ramping up the maximum approval number, it starts to make a little bit more sense now. But more importantly, this signals to me. I want to know, what is it signaling? It's signaling to me that the government is again coming in and trying to basically put a floor under the bottom of the housing market. So they want to incentivize more first-time buyers into the market. And then at the same time this is all playing out, you have HSBC this past week basically just broke all these headlines and history in Canada. They now have a 0.99%, sub 1% mortgage rate in Canada. Okay, so I know there's some stipulations around that. FYI, this program does not have a timeline where you have to sign up and do that. It is an insured mortgage. Again, federally guaranteed mortgage. So they're incentivized to create them. Sub 1%. So you have a sub 1% mortgage. It has to be insured, and I believe it had to be variable as well. So there's some it's not a 5-year fix on a $1.5 million mortgage. No, but if you're looking for a variable rate mortgage, and you're putting down 10%, and your purchase price is say $500,000-$600,000, you can borrow at HSBC for 0.99%. And so this is the game. The banks are aggressively trying to undercut each other for business. They're trying to create more residential mortgages at more attractive price points. They're willing to shrink their net interest margins in order to gain new customers because they view this as their most profitable money-making business. So when all the banks slowly start to follow, I mean, they've already been doing this for the past 4 or 5 months during a pandemic and a recession, is they've been aggressively, in my opinion, they've been fairly aggressive in trying to acquire new customers in the mortgage origination space. So that's the dynamic. I just need to focus on what are the banks doing, because the banks are in charge of creating the credit. They decide how much they want to lend. And so that's been my whole focus, is just really watching that from a policy perspective and looking at the banking data and saying, okay, something is going on here. It's very, very difficult now for real estate prices to fall or collapse if the banks are aggressively funneling money out the door as quick as possible. Now again, eventually at some point, I understand that maybe the bond market gets away from them, maybe mortgage rates shoot up because people lose faith in the bond market, and then the banks have to aggressively tighten credit because they're afraid of losses, and then it can create that downhill spiral. I understand that, but in my opinion, I don't see that in the near-term horizon. As I've said before, I think the Bank of Canada comes in, and I think eventually, at some point, they will be forced, similar to Japan, you'll nationalize the bond market. You will own 100% of all government debt, and there is no bond market that trades. In my opinion, that's where we're going. Again, you can agree with it, you can disagree with it, you can hate it, but I am trying to be as agnostic about it as possible. It's simply, I think it's just, the reality is that there is zero percentage of society that can actually tolerate rising real interest rates. The government can't tolerate it, the corporations can't tolerate it, and the households can't tolerate it. So that is my bullish thesis on the housing market. Not that I want it to go up or think that it should go up. It's merely just looking at what the banks are doing and what the policymakers are doing, more specifically, that they continue to go back to the well, and the well is housing, because it's ultimately used as a mechanism for credit creation, and it is ultimately the backstop of these banks. It's the collateral value of the bank's loans is against the real estate values. If the real estate values go like this, the currency goes like this. So that's how it works. Hope that video helped. If it brought you any sort of value and entertainment. I understand that it's not necessarily an easy topic to understand. In fact, there's a video by Mike Maloney on YouTube right here. I encourage you to check that video out, because in my experience, that has been one of the easiest videos to actually explain how banks essentially create money. So see you next week.